Welcome to Week 5 of Principles of Financial Accounting. Week 5 is about two unrelated topics. The first one is how we value inventory, and you've got a few options: FIFO, LIFO, and weighted average. And the second topic is depreciation methods. So the first topic, inventory valuation, technically it's called cost flow assumptions. As I said, you've got three choices: FIFO, LIFO, and weighted average. Keep in mind that these are strictly on the books. These are not how inventory physically flows. For instance, FIFO means first in, first out. LIFO means last in, first out. Just because it says LIFO, that does not mean we take the last inventory to come in and it's the first to go out. That is strictly on the accounting records. Physical flow of the inventory is always FIFO. So you've got three options here: FIFO, LIFO, and weighted average. The company gets to choose which method they want to use. Once they choose a method, it's really difficult to change it. You actually have to get permission from the IRS to change your inventory method. And the reason for that is because it has, if you keep changing back and forth, it has an impact on your net income, an artificial impact. So that's why you can't change your inventory methods. If you go to 5.2 and scroll down, this particular section does have a nice video that explains the difference between the cost flow assumptions and how to calculate them. So if you don't want to read all this detail, you might want to go straight to that video to get an overview of the cost flow assumptions. The second main topic is depreciation. And for the most part, I think all of you know what depreciation is. Depreciation, if you own a car, you know what depreciation is, because all vehicles lose value pretty much the minute they are driven off the lot. And that's exactly what depreciation is. Depreciation is the using up of a long-term fixed asset. Of course, we don't know specifically how much of your asset you're using, so the depreciation methods, the way we calculate depreciation, is just an estimate. For one thing, you're estimating how many years or the life of the asset, and you're also estimating how much the salvage value is. But the depreciation methods, they're fairly straightforward. You're putting a few numbers into a formula to determine how much the depreciation is. Even if you don't want to stick the numbers into the formula, in the content for this week, it shows you how to use Excel to calculate two of the methods of the depreciation. So depreciation is the using up of an asset. Technically, depreciation is referred to as cost allocation because you're moving the cost of the asset to an expense. So if you buy a piece of equipment for $50,000 and it's going to last for 10 years, you're moving $5,000 a year from the asset to depreciation expense. And companies love depreciation because it reduces their net profit. Well, if their net profit is reduced, that means their tax liability is reduced. So this happens, and you don't write a check for depreciation, so you reduce your tax liability without affecting your cash flow. So unlike individuals who have depreciation and cannot write it off on their tax return, businesses can. So those are the two main topics in Week 5: depreciation methods and valuing inventory. Let me know if you have any questions.